Now it's time for the number 3 factor in identifying a quality business, and that is my favorite metric, which is the free cash flow. To identify the free cash flow, we look at the cash flow statement of the business. We take the cash generated from operations and we minus the capital expenditures. Now, why the capital expenditures? The capital expenditures are the required reinvestment in the company to keep the company going. With all businesses, without reinvestment, there is no growth. So all companies have something that they have to reinvest into the business in order to keep it operating and to keep it growing. That is the capital expenditures, the required reinvestment into the company. So we look at the cash generated from operations and we take out the capital expenditures. What's left is the free cash flow. Now the free cash flow is the most important number in a business, in my opinion, because that is the amount of money that is used for acquisitions, reinvestment into the company, buying back shares, and also paying dividends to the shareholders. You want to invest in companies that are free cash flow positive, companies that are growing their cash flows year over year, or at the very least have strong cash flows if those cash flows are not growing. That is what's going to increase the cash balance and make sure that the company can stay out of trouble if they have those cash reserves, or be able to pay down debt, as we'll talk about next. When evaluating a business, I believe the free cash flow is the most important figure that there is. Number 1, the free cash flow can be used to assess the profitability or vitality of the business. It can be used to assess if the business has too much debt. It can be used to assess the payout ratio. However much of that free cash flow is being paid out in dividends is the payout ratio. Also, even valuation, you can look at the total market cap of the company compared to free cash flow and get an idea of the valuation of the business. So it gives you an alternative to the PE ratio. So there's so many things you can learn about a company by looking at its free cash flow. That's why it's the most important metric in analyzing a business. So again, free cash flow is the cash from operations, and you subtract the capital expenditures, which is the required investment into a business. What's left is a free cash flow.